And so today we're going to be covering the last chapter in our text, and this deals with understanding and analyzing consolidated financial statements. So when we finish this chapter, what we want to be able to do is to contrast accounting for investments using the equity method and the market value method, explain the basic ideas and methods used to prepare consolidated financial statements, describe how goodwill arises and how we account for it, use financial statement analysis to evaluate an organization's performance, explain and use a variety of popular financial ratios, and to identify the major implications that efficient stock markets have for accounting. So how do we account for intercorporate investments? And that is where we define that as where one corporation owns the stock of another corporation. And there are really three methods for accounting for this intercorporate investments. One is the market value method, the equity method, or the consolidation. So an investment in less than 20% of the common stock of another company normally requires the market value method. An investor using the market value method shows the investment on its balance sheet at market value, or also called fair value. Companies also often call such investments marketable securities in the financial statements. So that's if company A owns 20% or less than company B, they would account for this using the market value method. So less than 20% market value method. So if the investor, if company A owns between 20% and 50%, they account for them using the equity method. So the equity method adjusts the acquisition cost of an investment for dividends received and the investor's share of earnings or losses of the investee after the date of investment. Now, let's consider a company that has an effective control over another company. Usually this means it owns more than 50% of the company's stock. We call the controlling company a parent company and the controlled company a subsidiary. Although parent and subsidiary companies typically are separate legal entities, in many regards they function as one unit. The parent-subsidiary relationships require special accounting treatment. Parent companies issue consolidated financial statements that combine the financial statements of the parent company with those of its subsidiaries. That is, we account for the parent and subsidiary companies as if they were a single entity. So the effect of such transactions on the income statement depends on whether management classifies them as trading securities or available for sale securities. Trading securities are investments the investor company intends to sell in the near future. Available for sale securities are investors that the investor company does not intend to sell in the near future. And so again, this is how we classify these investments if we're accounting for them. That is, we own less than 20% of the shares of another company, this market value method, then we either classify these securities as trading securities, which we've defined, or available for sale securities. So trading securities and available for sale securities provide returns to the investor in two ways: dividend revenue and changes in market value, right? And we talked about dividends before. So a dividend is simply considered a return or a distribution of capital to shareholders, and changes in market value don't really become a distribution until the company sells its holdings. So where dividends are recorded, the investor company records dividend revenue on its income statement when received for both types of investments. It also accounts for changes in market value for both types of investments by increasing or decreasing the value of the asset. However, on the owner's equity side, the investor company accounts for changes in market value differently for trading securities than for available for sale securities. As you can see from Exhibit 17-1, the only difference between trading securities and available for sale securities is how the change in market value gets incorporated into the shareholders or stockholders' equity. For trading securities, price increases and decreases are included in net income and therefore become part of the retained earnings. For available for sale securities, price increases and decreases affect a different component of stockholders' equity, other comprehensive income, or loss. And so this just gives us a summary of the effects of trading and available for sale securities on both the income statement and the balance sheet. So now let's move into the equity method. And so again, when we talk about the equity method, remember that that means the investor who usually holds between 20 and 50% of the common shares of the investee. These companies must use the equity method to account for these investments, which adjust the acquisition cost of an investment for the investor's share of earnings or losses of the investee after the date of investment and for dividends received. Investors increase both income and the carrying amount of the investment by their share of the investee's earnings, and they decrease the carrying amount of the investments for dividends received. So now let's consider a company that has effective control over another company. Usually this means it owns more than 50% of the company's stock. We call the controlling company a parent company and the controlled company a subsidiary. Although parent and subsidiary companies typically are separate legal entities, in many regards they function as one unit. And so the issue is, why have subsidiaries? Why isn't every company a single legal entity? And there are several business reasons. For example, subsidiaries often limit risk. They save income taxes. They help conform to government regulations. They may allow the parent to do business in a foreign country. The parent-subsidiary relationship requires special accounting treatment. Parent companies issue consolidated financial statements that combine the financial statements of the parent company with those of its subsidiaries. That is, we account for the parent and subsidiary companies as if they were a single entity. And that's because consolidated statements give investors a more accurate picture of the whole organization's health. So let's look at the issues that arise when consolidating financial statements. When consolidating parent and subsidiary financial statements, accountants must avoid double counting of assets, liabilities, and stockholders' equity. Accomplishing this is a complex process in real companies, but we can see the basic principles in a simple example. Suppose company P, parent, acquired 100% of the common stock of S, subsidiary, for $210 million cash at the beginning of the year. Note that P purchases the common stock of S by paying the $210 million to the former owners of S as private investors, not to S itself. That is, P's purchases of stock in S does not affect S' book. S does not disappear, but it lives on as a separate legal entity, but with a different owner. Each legal entity has its individual sets of books. The consolidated entity does not keep a separate set of books. Rather, it relies on the accounting records of P and S. The consolidated statement combines all assets and liabilities of both the parent and the subsidiary, but eliminates instances of double counting. Investment in S appears in the first column because it is a focal point in this chapter, not because it comes first in the actual balance sheet. Each legal entity has its individual sets of books. The consolidated entity does not keep a separate set of books. The table analyzes the balance sheet accounts of both companies, and the last line is the consolidated balance sheet for P after accounting for its acquisition of S. And so what we see is that we have the parent books plus the subsidiary books equals a preliminary consolidated report, and then we reduce that preliminary report for any eliminating entries to remove double counting, which result in consolidated reports to investors. And so now we'll talk a little bit about what this eliminating entry is with respect to double counting. So we make adjustments in two places to eliminate double counting. One is the investment in S on P's books, and the stockholders' equity on S's books. In summary, if the $210 million elimination of the reciprocal accounts did not occur, there would be double counting on the consolidated balance sheet. Now let's look at how we combine the income of a parent and a subsidiary. A parent company carries its investments in subsidiaries such as this investment in S on its balance sheet by the equity method described early in this chapter. Suppose S has a net income of $50 million for the year. P's statement shows its own sales and expenses plus its share of S's net income as the equity method requires. The consolidated statement, that is the last column, adds together all the revenue and expenses of the parent, first column, and the subsidiary, second column. And so here we see where these accounts are the assets, which equal liabilities, and shareholders' equity are then combined. And we see the effect of changes in P's accounts, S accounts, and then the consolidated accounts in millions of dollars. So in the preceding example, P owned 100% of S. What happens when the parent holds less than 100 but more than 50% of the stock of subsidiaries? In such a case, a consolidated balance sheet includes an account on the equity side called non-controlling interest in subsidiary, or simply non-controlling interest. The account summarizes the outside stockholders' interest as opposed to the parent's interest in a subsidiary corporation. It arises because the consolidated balance sheet includes 100% of the assets and liability of a subsidiary, even when the parent owns less than 100%. Suppose the parent owns 90% of the subsidiary stock, and outsiders to the consolidated group own the other 10%. The non-controlling interest account is a measure of the outside stockholders' interest. The diagram that follows provides an overview of the role of the non-controlling interest account in the consolidated statements. The consolidated statement or consolidated balance sheet includes all of the subsidiaries' assets and liabilities item by item. However, because of the outsider's interest, P does not have an ownership claim on all of the assets and liabilities listed. The non-controlling interest account in effect summarizes the outside stockholders' equity ownership interest, and the remainder after deducting non-controlling interest is P's total ownership interest. And so this diagram provides an overview of the role of the non-controlling interest account in the consolidated statements. So we can see that the purpose of this non-controlling interest account is to reduce the amount on P's books of its ownership of S, since it doesn't own 100% of it. And here's an example then of the consolidated income statement with a non-controlling interest. And so again, you can see that we combine the income statements of P with the income statements of S to get a consolidated statement, but then we have to reduce the operating income for the non-controlling interest. That's 10% of the subsidiary's net income, and we can see that S, or the subsidiary, had net income of $50, and so 10% of that is the $5, and so we reduce the combined operating income by $5 to get to the net income on a consolidated basis. And so this shows us the consolidated balance sheet in millions. And so again, we have assets which show investments in S, cash and other assets. We show liabilities. We take those down like we normally would and we show our eliminating entries. And then we also would show this, notice the non-controlling interest under the stockholders' equity section. And so now we consider one or more complications that arise when a company purchases more than 50% of another company. The previous examples of company P and S assumed, 1, the acquisition cost of S by P was equal to the amount of the stockholders' equity or book value of S, and that the book value is equal to the sum of the fair market value of the assets and liabilities acquired. In actual acquisitions, the total purchase price paid by P often exceeds the book values of the net assets acquired. In addition, the purchase price also often exceeds the sum of the fair market values or current values of identifiable individual assets less the liabilities. For example, when Philip Morris paid $13 billion for Kraft several years ago, it assigned only $2 billion to identifiable individual assets. It assigned the remainder to Goodwill. Recall from Chapter 16 that Goodwill is the excess of the cost of an acquired company over the sum of the fair market value of identifiable assets less liabilities. And so companies record goodwill as an asset only when one company purchases another and pays more than the sum of the fair values of the assets and liabilities acquired. A purchaser may be willing to pay more than the sum of the fair values because the acquired company is able to generate abnormally high earnings. So let's suppose that P acquired a 100% interest in S for $210 million. Suppose P paid $40 million more, or a total of $250 million in cash. The $40 million, or the difference between the $210 million and the $250 million paid, would appear in the consolidated balance sheet as a separate intangible asset account. It often is the final item in a listing of assets, and we can see it here under the assets where we have investment in S. The next column we will see is goodwill, and then that is netted against the investment in S. For example, a purchaser may be willing to pay extra because it expects excess earnings from potential efficiencies gained by combination, remanagement, or elimination of duplicate facilities and administration. It may expect excellent general management skills present in the purchase company, or a unique product line, or an established brand name and reputation. So there are various intangible qualitative factors that come into why a company might pay more than book value, which would result in this calculation of goodwill. So what if the book values of the individual assets of S are not equal to their fair values? To see the impact of goodwill on a consolidated statements, refer to our example where P acquired 100% interest in S for $210 million. If P paid $40 million more, or a total of $250 million, for simplicity, assume that the fair values of the individual assets and liabilities of S are equal to their book value. The balance sheets immediately after the acquisition are as follows. A $30 million amount would appear in the consolidated balance sheet as part of the equipment account, and $10 million in the goodwill account. Suppose the fair value of S's equipment exceeded its book value by $30 million in our example. So the fair value of S's equipment exceeded its book value by $30 million. That's where we say the $30 million would appear in the consolidated balance sheet as part of the equipment account, and $10 million in the goodwill account, because that $30 million plus the 10 gets us to the $40 million that we paid of $250 versus the $210 million worth of fair value assets. So the additional, because the consolidated statement would show S's equipment at $30 million higher than the carrying amount on S's books, the depreciation expense on the consolidated income statement would also be higher. So for financial statements to be useful, managers and investors need to be able to analyze and interpret the statements. Careful analysis of financial statements can help decision makers evaluate an organization's past performance and predict its future performance. Such evaluations help managers, investors, and others make intelligent, informed financial decisions. When comparing companies that differ in size, analysts often apply percentage relationships called component percentages to income statements and balance sheets. We call the resulting statements common size statements. This is an example of common size statements. And so here we can see that for the income statement, and we're looking at 2010 versus 2011, we restate the items on the income statement in proportion to their percentage of revenues. So cost of revenues in 2011 were $20,862,000. Cost of sales were $11,354,000. And so the $11,354,000 as a percentage of the $20,862,000 in revenue is 54%. The gross margin of $9,508,000 is 46%. The total selling and administrative expenses as a percentage of revenue is 32%. And we do that same calculation for 2010, and we apply, or we calculate the percentages of cost of sales, gross margin, selling, general, administrative, operating income, interest expense, etc., each as a proportion of revenues on the income statement. And this allows us to get to some comparability between years. We may be doing this between different companies, and this would allow us to get some comparability between those different companies. The balance sheet is the exact same method. It's just that the general base that's used to convert to are total assets. So if we look at the 2011 balance sheet column for current assets of $11,297, that's 75% of the $14,998. And the property, plant, and equipment is $2,115. That's 14%, and so on all the way down the balance sheet. And we do the same for 2010. And so again, we're able to compare year over year based on some common, what we call common size statements. And remember, on the income statement, it's generally they're common sized according to revenues. On the balance sheet, they're common sized according to assets, generally. So corporate annual reports to the public and 10-K filings with the SEC must contain a section called Management's Discussion and Analysis, or MD&A. This section explains the major changes in the income statement, changes in liquidity and capital resources, and the impact of inflation. The focus is on a comparison with the prior year or years. So analysts rely heavily on the trend of a company's ratios. Annual reports typically contain a table of comparative statistics for 5 or 10 years, just depending on how the presentation format of the organization. And so what we see are this idea of comparing certain key metrics such as return on sales, return on stockholders' equity, earnings per share, and other similar key ratios and metrics across reporting periods, so that it provides analysts with information, it provides them with trends, it equips them to ask questions of management that management should be able to answer to about what's happening in an organization with respect to financial performance. And so evaluations of financial ratios require comparisons. There are 3 main types of comparisons. One is this time series comparisons with a company's own historical ratios that we just looked at. Another are benchmarking comparisons with general rules of thumb. And so that says that, well, for a similarly sized firm in a similar industry, the average particular ratio is X, and for our company that we're looking at, that ratio is Y. And so what accounts for any significant difference between the two? And then there's this third type, which is a cross-sectional comparison with ratios of similar companies or with industry averages or best practices ratio for the same period. And so here we see some typical financial ratios, and we are given the calculation. So if we look at short-term ratios, we're looking at a current ratio, which is current assets divided by current liabilities. If we look at something like average collection period in days, we look at average accounts receivable times 365 divided by sales on account. If we look at debt-to-equity ratios, we look at total debt to equity, which is total liabilities divided by stockholders' equity. And we can go all the way down the page here to see some, what is the calculation of these typical financial ratios. And there are many, many more financial ratios. But generally, we see these financial ratios presented in terms of, well, Do they reflect a firm's short-term liquidity, or do they reflect a firm's long-term solvency? Do they reflect market valuations, right? Do they reflect debt to equity or efficiency or profitability ratios? So there are certain consistent buckets across the industry that these ratios can be put in. And they're very interesting in that they generally will tell interesting stories about a company. And they're strong tools that financial analysts use in the So the rate of return on invested capital is an important measure of overall accomplishment. On the surface, the measure is straightforward, but its ingredients may differ according to the purpose it is to serve. So what is invested capital? The denominator of the ratio, right? The ratio is return on investment, which equals income divided by invested capital. Well, the measurement of operating performance, that is how profitably managers employ assets, can be separated from the influence of management's financial performance decisions, that is how they obtain and finance these assets. The best measure of operating performance is pre-tax operating rate of return on average total assets. Research has shown that financial ratios and other data, such as reported earnings, help predict such economic phenomena as financial failure or earnings growth. Furthermore, analysts use many ratios simultaneously rather than one at a time for such predictions. Above all, the research shows that accounting reports are only one source of information and that in the aggregate, the market is not fooled by companies that choose the least conservative accounting policies. In sum, the market as a whole generally sees through any attempts by companies to gain favor through the choice of accounting policies that tend to boost immediate income. Thus, there is evidence that the stock market may indeed be reasonably efficient, at least in the reflection of most accounting data. In the end, investors have two basic choices: to trust their investment decisions to experts such as investment advisors or mutual fund portfolio managers, or to carefully analyze information from a variety of sources, including companies' financial statements, and then make their own investment decisions. And so this completes Chapter 17. I encourage you to go back and read the chapter closely with respect to consolidated financial statements. These are complex concepts and are difficult to understand and sometimes need to be reviewed several times. And then move on to the discussion forum and the learning exercises. And so thank you very much for your time today. And I've enjoyed the semester, this being the last chapter that we're going to review. And I've enjoyed the semester. I hope you found the information interesting and something that you'll find useful as you move forward in your career. And I look forward to hopefully seeing you or being with you in another class. Thank you.